The idea of taxing unrealized capital gains is getting floated around out there. This has very clear drawbacks. I'll share 3 of them. That and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Kamala Harris recently in her camp came out and said that they supported the idea, the changes to capital gains tax that were proposed sort of discreetly within the Biden camp's most recent budget. Now, we're not going to go through all of the changes in detail because they're nuanced, okay? But in that budget, there was a suggestion, a proposal to increase the capital gains rate. The highest capital gains rate would be into the 40% tile range, which would mean it's highest in decades and decades. But it also included a tax on unrealized capital gains. Here's how it works right now. Say that in a non-IRA, non-Roth IRA, non-401k, so a non-tax shelter investment account, so an individual account or joint account, say you buy the S&P 500 index. Say you buy an exchange-traded fund, S&P 500 index. Say you put 10 grand into it a while back, and today it's worth $15,000. Well, you made 5 grand, but you haven't sold the investment yet. So this is a capital gain. It's a gain, but it's unrealized because you haven't sold it. The gain, I mean, the 15 grand, the stock market could go down and it could go back down to 10 grand. So currently it's a gain, but it's unrealized because you haven't sold it yet. And therefore, is that $5,000 taxable? No, it's not taxable. That's not capital gain. It's not a taxable capital gain until you sell it. So if you sell the investment now, the S&P 500 index at $15,000, then you'll get a tax form. You'll need to report that $5,000 of capital gain. And if you held it for less than 12 months, then wow, that did phenomenal. A 50% rate of return less than 12 months, but I digress. Then it would be short-term capital gains taxed at your ordinary income tax rates. But if you held it for more than 12 months, which you would have in this case, the S&P 500 hasn't gone up in 50% within the past year, then that would be a long-term capital gain taxed at 0, 15, or possibly 20%, depending on your tax situation. But the point is, it doesn't become taxable until you realize that gain, until you sell the investment. Because until you sell it, the price is still floating, right? Well, the proposal is now to begin taxing those unrealized capital gains, the appreciation. This would be wildly complicated, right? Because this would consistently shift your cost basis. So if you purchased it at 10 and now they start taxing it because it moved up to 15, well, now you've got to start tracking from 15 and below. It would be a monstrosity. In addition to that, it would cause some serious challenges for the overall economy. And here's the 3 biggest. First, and the obvious problem is if they began taxing you on unrealized appreciation, so a gain that you didn't realize, you would then have to pay tax on this gain and you wouldn't have the proceeds from a sale to do so. So you would have to pull money out of the economy somewhere else, out of hopefully productive investment or whatever, to actually pay the tax. So obvious problem number 1 is, well, I never sold anything, I don't have any proceeds, but I'm now gonna have to pay some tax, and therefore I'm gonna have to pull money from somewhere, pulling it out of the economy and giving it to Uncle Sam, paying taxes. And that sort of dovetails right into problem number 2. What it's going to do is it's going to cause a lot of people to have to sell some investments in order to come up with the cash to pay the tax, right? So unless you have dollars sitting aside somewhere else that you can grab and use that to pay the tax, okay, that works. I would argue it pulls money out of a productive asset and moving it into paying taxes. So bad for the economy. But worse yet, problem number 2 is you might need to sell some investments to then cover the tax. Extra selling pressure, one at a time, not a big deal. But millions of people at a time, now that creates more downward pressure on stocks and the overall investments, and materially could influence or change the performance pattern of these investments. The second issue with that alone, needing to sell stocks or sell your investment just to pay some of the tax on the unrealized capital gain, it creates more of the problem, right? Now you're selling more, you're creating more capital gain. And then third, you have less compound interest potential, right? Because now you'd have fewer shares because you had to sell the investment, therefore limiting the amount of wealth you're able to build. See, all of this starts to create more drain and friction in the investment space, could potentially create challenges for the overall economy. And then finally, beginning to tax unrealized capital gains would be even more problematic for illiquid investments. So think about this. Imagine you owned a business and that business grew in value over the year. Now you've got to pay tax because that business is now worth more. Well, it's a family business or it's a small business. It's you can't just sell shares of your business, and therefore you've got to use cash somewhere else, either from the business or from you personally, to continue to pay the tax as the business value grows. You're blessed because the business value grows. Fantastic. Yet you're using liquid assets and draining liquid assets to pay the tax. And now more and more of your wealth is concentrated in this illiquid investment. You do that in the short term, you can probably, I don't like saying this phrase, but rob Peter to pay Paul. You can probably shuffle things around, play the shell game. But exacerbate that over a decade, or in a family business, a generation. And all of a sudden, you could force someone into having to sell the family business or part of it, sell the family farm or part of it, sell a rental property or part of it, even though they have no intention to. That wouldn't be a prudent business decision. They would need to create liquidity in order to pay the tax on the growing value of the business. And if you say, well, I don't own a business, sorry for their luck. What about your house? Imagine your house continuing to go up in value, and that creating and having that create tax that you owe beyond property taxes, and that's taking, instead of you saving up for retirement or using cash to do other things, you've got to use cash to pay for the tax as the house gets more and more worth more and more and more and more. Yes, the property taxes go up, but this unrealized capital gain would go up as well, potentially making your overall net worth and finances less and less liquid. So 3 very distinct problems with this for the economy. That's one of the reasons why, like it or not, and I get very frustrated with the overall tax code, they've tried to be very favorable on how to tax investments. That's why capital gains taxes have been a little bit lower, because they want to encourage investment that is healthy and productive for the overall economy. Starting to tax unrealized capital gains would do the exact opposite and would be harmful for the economy. This proposed change is not law yet. Let's be watchful for that. Stay tuned right here to this channel, because as that gains momentum, if it does or becomes law, we'll talk through it and all of the planning issues. Work with your CFP on your tax planning strategies and how you can use tax sheltered to protect Uncle Sam from reaching too quickly or too much into your hard-earned savings and pulling dollars out. Build that tax shelter strategy with your CFP. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.